Let's kickstart the first conversation of the day. Now, filing of income tax returns is a very crucial leg in the process of being up to date with the regulations that govern the paying of tax. To talk about the implications of not doing that, and also to set you up at the start of the financial year for everything that you need to do over the course of this year so that you're in time for everything, I have with me Arvind Rao, who is a certified financial planner and a chartered accountant and the founder of Arvind Rao Associates. Thank you so much, Arvind, for taking the time. Good evening to you. Let's start with a basic question, which essentially is what are the rules that govern the filing of income tax returns, both for the previous assessment year, that is assessment year 22, and the current assessment year, which ends 23?
Hi, Alex. So rules have not changed much when it comes to both these years. The basic provision under the Act says that if and as long as your taxable income exceeds the basic exemption limit of 2.5 lakh of rupees, which in case of senior citizens stands at 3 lakhs. So as long as your income is above this, you are obligated to file your return of income. And mind you, while saying this, when the Act refers to the taxable income, we're talking of the income which is before you consider any deductions on account of ATC or other investments that are done. So what is normally in the tax context referred to as the gross income. So as long as your gross income is above this, you are obligated to file your
return. There was an allowance made in the reason I asked this, Arvind, is that I think that there was an allowance made in the previous financial year on account of the COVID-19 pandemic that allowed for certain grace period to file the income tax returns. Which is why I was asking, when was the last date to file income tax returns in the previous year, and what is the last date to file it now?
So let me start answering this in this way, that ideally or normally the due date for filing tax returns for individuals who are not liable to audit is 31st of July. In the last year, because of the pandemic, or I think 2020 was the year because of the pandemic, there was a extension of the due date. When it came to 2021, not only was there the second wave, but also the portal underwent, like they upgraded the portal, and there were some new features introduced. There were some glitches in the portal after this was done, because of which the due date was again extended, and it had moved up to 31st of December. Now, this year, that is in 22, till date, there has been no communication in terms of any extension. So, having said that, the due date remains 31st of July for these categories of taxpayers.
Now, there was an article that I was reading, or even a circular that talked about the penalties for non-completion of the filing process. Could you explain to my viewers what those penalties are? What are the implications of not filing your income tax returns?
So, Alex, I'd like to break your question in two parts, which is the implications of not filing the tax returns within time, and then I'll go on to talk about implications where you are not able to file your returns because you have moved beyond that time zone available to file. So, like I mentioned a couple of sometime back, that 31st July is the due date. So, people who miss the bus to file by 31st of July, in case they file it within 31st of December, then there is a late filing fee, which is also can be called as the penalty for filing late. That is 5,000 rupees. And for people who miss the December bus and who will file it from Jan to March, the penalty is higher at 10,000 rupees. Now, in addition to this penalty, in case there is any tax that remains payable, what is generally called as the self-assessment tax, that a person has to pay before filing their returns, then there is also this interest for late payment of taxes that becomes applicable, and it is calculated at the rate of 1% per month. starting from the month immediately after the due date. So in our case, since 31st July is the due date, so from the 1st of August, there is an interest at the rate of 1% per month that becomes applicable for late filers. So all this is for these penalties and interests are for people who are filing their return late. Now, what happens in case you do not file the return and it goes beyond March? So one is obviously the window to file the return stops after the 31st of March. In that case, what happens is, in case the department picks up the an individual's return for not having filed it within time, and obviously there would be certain income that goes not declared because the return was not filed, in which case there are penalties. The penalty starts at a minimum of 50% of what is called as the unreported or underreported income, and on the higher side it can go up to 200% of the tax. So and mind you, when we're talking of penalties, interests they continue. So whatever is the tax that remains unpaid, you are liable to pay that tax plus the interest on those, on that tax, plus these penalties, which is 50% of the tax, or on the higher end 200% of the tax. These are all things that we can put in numbers. The other big thing that a taxpayer may lose in case they do not file their returns on time is the ability to carry forward losses, especially capital gain losses, or even, I think if we exclude speculation, the capital gain losses, that is, losses that you may incur on account of trading of shares or mutual funds, those you cannot set off these losses against next year gains, if any, if you have not filed your returns on time. So in addition to taxes, interest and penalties, there is also a loss of privilege to carry forward losses and set it off against future gains. So I think these are majorly the disadvantages or the benefits one loses in case you don't file it in time.
That there was another disadvantage in that you could have higher tax deducted at source if you do not file your income tax return, I believe for a couple of years in a row, right? Could you explain what that means and how does that work?
Sure. So in order to persuade people to be regular in the tax filings, because I think that's where the typical trend has been to encourage tax compliance. So it's been, I think, in 2021 budget, this provision was introduced, which said that if a person who has TDS, that is tax deducted at source, in the previous year, greater than 50,000, and who has not filed their returns for 2 years consecutively, then in that case, what happens is they are liable for a TDS deduction on their current year income at double the applicable rate. So, for example, generally TDS on the interest paid on fixed deposits by banks is around 10%. So, in case the bank finds out that this particular PAN for a taxpayer, and there is, and just to add a point here, that there is a utility that has been provided by the income tax department to various institutions, wherein they can input a PAN and find out whether this PAN has filed returns for the last 2 years or no. If the answer is no, then when they deduct tax, they're supposed to deduct TDS at the double the rate, the one that is applicable. So this can be quite cumbersome for the taxpayers, because the only way they can claim back this TDS in case there is no taxable income for them is to file the return. So this is, I think, a big setback for taxpayers.
Also pertain to salaries, because obviously your tax deducted at source when you're talking about your salary is based on the declarations that you've made in terms of tax saving instruments, right? So does that TDS amount also go up there?
I mean, the provision has been kept very clear. It is double the rate. So they haven't given the breakup in terms of what kinds of income. But I would like to believe that yes, it will also be applicable for salary.
Let's talk about who has to file a tax return? Because there is a very clear list, Arvind, that talks about who has to file and who is exempt. I also understand that that list has undergone certain changes. So where does the list stand right now?
So let's put it this way. The first time you asked me this question, I gave you a clear answer that all those people whose gross income exceeds the threshold of 2.5 lakh of rupees are liable to file returns. But over all these years, the department has been able to come across cases where many people have not filed their returns because they do not qualify in this criteria of income exceeding 2.5 lakh. Yet, there have been, or they have been undertaking a few transactions which the department believes is a trigger to have them file their returns. So, in addition to this criteria of 2.5 lakh of rupees, around 3 years back, the law introduced certain additional criteria which, if fulfilled by the taxpayers, they have to file their return independent of what their income is. These criteria were: one is if you're depositing 1 crore or more of amount in a current account. So this is applicable for taxpayers who run a business or who operate a current account for whatever reason. Two, if you're undertaking a foreign travel and the expenditure on such foreign travel is in excess of rupees 2 lakhs a year. So if that happens, again, then you are obligated to file your return. And third is a very peculiar thing where the electricity bill for a year, the sum of all the bills that you have paid, if it's in excess of 1 lakh, even then you are obligated to file your return. Now, these were the three things that came in 2019. Now, just I think a few weeks back, they have added few more criterion here for people, and they go like this, where the total turnover or sales or gross receipts, by whichever name you may refer it to, in a business, if they exceed 60 lakhs in a year, even then the business person has to file a return. Doesn't matter if they made profits which is less than 2.5 lakh of rupees. Or in case a taxpayer is a professional, in which case the gross receipts exceed 10 lakhs, even then they're obligated. Third, and this is interesting, where the aggregate or the total of TDS that has been deducted on in respect of a certain pair across different categories of income, if it is more than 25,000, and mind you, in case of a senior citizen, this limit is 50,000. So wherever this limit is breached, even they are required to file the return. Now, obviously, somebody would want to argue here that if I have TDS more than 25,000, why would I not file a return? Because if my income is less than 2.5 lakh, I am actually foregoing this TDS refund that I could have claimed. But Alex, believe me, there are people who have not been filing. One, because they're not aware that they have to file, and hence this new criteria now makes it obligatory for these people to file the returns of income. And the fourth category here, which is the new one, is that in case you're depositing more than 50 lakh of rupees in your saving bank account in the previous year, even then you're obligated to file. So the first set of new conditions that came talked only of current accounts, and the latest set of conditions that have come have bought into their fold savings accounts as well. So, Alex, there are around 7 conditions today or 7 situations today where, if satisfied, a taxpayer is required to file the return of income independent of whether they're crossing the basic limit of 2.5 lakh or not.
Understood. Okay, so I think if I'm understanding this correctly, Arvind, this is an attempt by the tax department to close certain breaches that it has identified. So they're basically trying to close all the gaps. Now, the other thing that we have to bear in mind at the start of the financial year is advance tax. Let's also establish that very clearly, because I think the first deadline is just a short while away. What do people have to bear in mind in terms of advance tax payment? Who has to pay and how much do they pay?
So this I have observed is always a big question in taxpayers' minds, especially when I have spoken to salaried taxpayers. Generally, salaried taxpayers tend to believe that mera all tax is getting deducted by way of TDS, which yes, as it relates to the salary income, but advance tax provisions make no differentiation between the types of income. So the simple rule for advance tax is that if the tax is payable by a taxpayer after giving credit for whatever TDS has been deducted, if it is more than 10,000 rupees per annum, then you are supposed to pay the taxes that is liable on your account in installments. There are four prescribed installments by the law. One which falls due on or before the 15th of June. Next is 15th of September. Third is 15th of December. And fourth is 15th of March. So if you happen to be somebody who draws up an estimate of their income, calculates the tax liability on it, and finds that after giving credit for all the TDS that has been deducted or will be deducted, if the aggregate liability to pay is still more than 10,000, then you need to start paying advance tax right from the next month, which is of June. Alex, one more point to add here, that people who happen to either underestimate their income or wrongly estimate their income and hence pay lower advance taxes in either of these installments, the law also says that even if they pay the deficit tax by the 31st of March of every year, that is also good, because what we are not talking about right now is that any failure to pay advance tax, or if you're paying your advance tax short, then there is also this interest that becomes applicable for all these installments. So if in case you're making up for the shortfall or non-payment of advance tax in these four installments by making a payment after the 16th, anytime from 16th of March to the 31st of March, at least one will be saving the interest for non-payment of advance tax that becomes applicable from the 1st of April next year. So this is broadly how advance tax works.
Last point that I would like to ask you, and we won't get into the details of which tax saving investments. I think we do that on an ongoing basis. There are several options available under ATC, ATC-CD, and several things that you can do. What advice would you give to people as we are sitting, past the middle of May with 10 months left? Do you think it's a better idea to start now rather than waiting for the end of the year?
Absolutely, for the simple reason that not everybody might be able to contribute for the tax saving deficit investments at one go. 10 months is a long enough time to apportion it and even distribute it. And Alex, just a small point to add here, that yes, if you go by the calendar year, financial year, you have 10 months. But let's also bear in mind that for all the salary taxpayers, typically 31st December, or I think on the higher end, 31st Jan seems to be the timeline by which they need to submit their proofs to their respective employers so that they can factor this in and do their calculate the tax liability. So we can easily take off 2 months from this 10. So there are like roughly 8 months or 7 months available for each of us to finish our tax savings, have the proofs in hand. So yeah, I mean, May or even June for that matter is good to get started on this mission.
Much, Arvind, for taking the time, and it's been an insightful chat. Hopefully this has benefited a lot of people.
Thank you, Alex, for having me.